Welcome to How Do They Afford That, the podcast that peeks into the financial lives of everyday Australians. I'm Michael Thompson. I'm a writer and co-host of the Fear and Greed Business podcast. As always, I'm with Canna Campbell, financial planner, founder of Sugar Mama TV, the financial literacy platform on podcasts like this one, obviously, books, YouTube, very big presence on Instagram, all over the place, really. Canna, what have you been up to this week?
I'm actually hunched over with shame and embarrassment.
Your body language at the moment is quite extraordinary.
I'm going to share this anyway. So if the idiot badge goes to me, but I had a very embarrassing frugal fail.
Oh, really?
Yeah, really embarrassing.
You look like you are actually embarrassed just to
I feel a little bit ill.
The shame of this. Please, go on. I'm sorry.
You're looking very joyful now.
The glee in my voice. I'm sorry. I'll be more somber. Could please go on, Canna.
So like many Australians, we're on a budget. We've got rising interest rates, the cost of living. And Tom and I had multiple chats in bed about just reining it in, sticking to the budget and just really being proactive and mindful with our money. And I have 3 children. And a lot of my friends have moved away. Like my best friends moved, out of Sydney, and I've got 2 younger girls, and most of my friends' kids are older. They're around my son's age, who's 9, turning 10. Not many of my friends have kids, around my 1 and 3-year-old mark. So I was saying to my friends, I need to widen my friendship circles with friends that have kids my age, so play dates can work easily. And I found a friend, and she was lovely, and her kids are actually exactly the same as my kids. She has 3 kids, same dynamic, boy, girl, girl, and our kids are actually born within the similar months of each other. And she invited me to come to sushi with my 3 kids and her 3 kids, and the friend that she wants to introduce me to that has 2 girls the same age as my girls. Very excited. We go to sushi. And my children are so badly behaved. So bad. There's sushi everywhere. My youngest, Tiger, is having a tantrum. My 3-year-old she's mischievous.
Derailed the sushi train.
Basically, yes. And she's actually now doing it with her new friend, which is my friend who's got the 3 kids as well. So we have 6 children going wild and behaving really badly. And then the new friend who turned up with her exceptionally well-behaved girls, sitting there neatly eating their sushi, being polite. Mine are like climbing the walls. Staff are complaining. Anyway, it came to leaving the restaurant. And it was okay, we need to get out of here. We've caused a scene. We've caused a lot of mess. And I said, look, I'll go fix this up. Don't worry about it. Thinking it's sushi. It's harmless. It can't be that expensive. The bill was $279.
$279.
I know. And it clearly wasn't. So I think what happened is the staff just hated all of us, particularly my children.
There's a cleaning fee in there. Yeah.
I think they put a don't come back tax. But because these are new friends and I didn't want to cause a scene, I just said no problem, tapped with my card and left.
Oh, no.
And my friends weren't there, so they didn't actually overhear or see how much this bill was. And anyway, in the car, like Tom calls, he's like, how did you go in making new friends? This is like dating. And I was like, I'm really, really sorry. We've just had this conversation. And the funny thing is, these are now become good friends of mine, and they have found out about the cost of sushi, and now it's like a running joke about that night where Canada spent $300 on sushi that was pretty much on the floor.
Oh my God, that is
I'm so embarrassed, but it's one of those things, you're trying really hard and you want to keep the peace, you don't want to create a scene. And if I'd been on my own, or if I'd been better friends, I would have said, hey, that doesn't add up right. But
you didn't want to look like you were kind of
like one of those people, which I actually am when I let my real self expose.
Hesitant to actually use any kind of word to describe.
Yeah, I couldn't let them see the inner psycho. I guess not that I am a psycho, but you couldn't show your comfortable side. Having said that, though, these are now become good friends of mine, and they are the type of girls that would go, no, that's not right.
Okay. That was good. I enjoyed that.
I'm so embarrassed.
No. Keep embarrassing yourself because it is very good content.
I'm now the sacrificial lamb.
You are. You certainly are. Usually it's me and my various kind of wrong assumptions. If you haven't heard my wrong assumptions, go back to the last episode about kind of never being too late to get interested in your money. I made a series of shocking assumptions, and Canna, you got quite cranky at me. Today's a different day, and everything is calm. We are talking today about interest rates, really, leading us into where we're going, because we've had nearly a year's worth of interest rate rises. There are warnings that there'll be kind of more to come. A lot of people talking about kind of how they cope and how they will cope with this, and like what to do when the cost of living is outpacing wage rises, when the mortgage is costing more and more every month, and it just keeps on rising. And one thing that does keep coming up is refinancing. So today I wanted to kind of find out all about that. What refinancing is, how you do it, some of the traps that we should be kind of wary of, and perhaps some alternatives to consider as well. There is a lot in that, and it is really important to know that as we're going through it, that what we're talking about is general in nature. It's not personal advice. It's not investment or strategic or product advice. It is purely for financial education purposes only.
That's right, Michael. Everything we're talking about is educationally based. So if you hear something you think, oh, would that be a good idea for me? That is when you must go and speak to a financial planner and ask them for personal advice based on your financial situation, goals, and deadlines.
You talk to a lot of people. You have a lot of conversations with people about money. There's been a lot of rate rises. How are people coping?
It's starting to get really frightening. I think a lot of people obviously have fixed some of their home loans or all of those home loans. And it's the pennies, I think, only starting to drop now as to what the impact of the new revert interest rate they'll be paying from going from a fixed to a variable is going to be. Also, I think, we've had these gradual 25 base interest rate rises. So it's been gradual. Now we're starting to see the impact of multiple interest rate rises and how the ability to actually pay down your mortgage is handicapped to a certain degree now because so much more of your repayments are going just towards interest. So people are stressed. And I read the other day in The Guardian that 25% of Australian mortgage holders are now in mortgage stress today. And it's scary because interest rates have not only increased more than most of us expected, they've actually happened so much faster than we could have ever imagined.
Yeah, it has just been kind of nonstop. It feels like it's been a fairly kind of consistent trend over the last year. That reference to mortgage stress is an interesting one because it feels like everyone is under stress at the moment, kind of feeling the pinch of not just rising interest rates, but the cost of living going up, power bills up, groceries up, all of that. And inflation is obviously kind of hitting costs all over the place. But in terms of mortgage stress, what does that actually mean? Because there's almost kind of a fairly strict definition around it.
There is. So mortgage stress is when 30% of your pre-tax income goes to your mortgage repayment.
Pre-tax?
Pre-tax.
Okay. All right. And so anything beyond that is considered mortgage stress.
Yes.
Because it is just not leaving necessarily enough money for everyday life.
Everyday life and any sort of form of, I guess, sanity or quality of life or lifestyle. And that is when you see people's budgets really running tight, where they've had to really just trim back absolutely everything just to make the mortgage repayment.
It was pretty scary, or I was always quite worried about people who secured loans during the boom of a couple of years ago when they were paying kind of 10, 15, perhaps 20% more than they would have a couple of years earlier because prices shot up so much. And it felt like they were borrowing money that really would have stretched them to the maximum. And then rates have risen quickly, as you say. And with other costs going up, surely it wouldn't be leaving much money for anything else.
No, I think a lot of families are really cutting it fine and they're trimming desperately left, right, and center. They're looking at their grocery bills. They're looking at, their subscriptions. They're questioning everything. And I will admit, I'm looking at my budgets as well. I'm looking at what we can do to save money and how do we make sure that we stay safe and secure, meeting the mortgage repayments without too much stress.
Yeah.
I think a lot of people are in the same boat. And with your comment about, I might even say assumption, about people borrowing so much a couple of years ago, you're right. People's borrowing capacity was much, much higher. These loans, if they were applying for them today, wouldn't simply get the same level of finance approved. So you're on the money there.
What about people who fixed their mortgages? And that was there was a lot of people, because some of those fixed rate loans were they were extraordinarily low.
I fixed our investment loans at 2.2%.
Wow.
But because we moved house, we had to let all those fixed rates go. So fixing your home loan can be great, but the devil is in the details, let's just say. Now, around about 800,000 households are about to come off their fixed rates this year. So they're going to be impacted dramatically by what we call the revert risk, which is you go on a fixed rate and you've fixed it, and in the meantime, interest rates are going up, and you lose the ability to fix in another interest rate because you're currently fixed on in my example, the 2.2 rate. So these people are going to be going from their 2.2, 2.3, 2.4, 2.5, whatever it was, to now the variable rate, which could be around about 5.5%.
It's a big jump.
It's a huge jump. And this is why I say to people, when you're running your numbers and looking at borrowing to invest and borrowing money, factor in not 3 interest rate rises, but a 3% interest rate rise so that you can check your numbers and know that you're bulletproof. Now, if you were to take a $600,000 loan on a 25-year term, that's an extra $1,000 per month after tax that household has to come up with just to keep managing the mortgage repayment. That's not extra money or lump sum repayments that's being put towards the home loan. That is your mortgage repayment going up.
And so the thing is, though, that it wouldn't be a surprise. Well, it shouldn't be a surprise to anyone, because they know if you have a fixed rate loan, you know when it's going to end, because it is for a set term, whether it be 3 years or 5 years or whatever the term of that loan is. So it is going to hurt when it happens, but you can prepare for it.
Absolutely. There are lots of smart things you can do in preparation. So obviously you would go back to your budget and look at, okay, what can we look to cut down or cut out permanently, temporarily, to help increase the cash flow so that we can prepare for those mortgage repayments being at the new rate of, say, 5.5%. You could also maybe look at stockpiling some savings so that you can make a lump sum repayment once that rate comes off, depending on obviously the terms and conditions, because some fixed home loans let you make a lump sum repayment, but only at a certain level. And it's also worked out on a period of time. So you need to check the fine print and speak to your bank and find out whether it's per calendar or whether it's the anniversary of the fixed rate or whether it's per financial year. So look at as to whether you can make lump sum repayments without any penalties or fees being applicable.
We have talked previously about refinancing. We've mentioned it kind of previously, and it's different to just negotiating a lower rate.
Correct.
It is a full new loan, essentially.
It's a new loan, and quite often it's with a new financial institution.
So is this an option for people in this scenario?
It most definitely is an option. It's not always the smartest option for the long run.
Okay.
There are consequences.
So it's very much a qualified yes, but it sounds like there's quite a sizable but.
Yeah, there is, but it's good to be aware of this so that you can help minimize or mitigate the negative consequences of refinancing.
What are the downsides to refinancing? What are some of these traps?
Well, it's a little bit of a Band-Aid, because what you are simply doing is delaying the date of paying off your home loan. This is because you are taking out essentially a new loan through refinancing, so restarting your mortgage journey. So say, for example, I took out a 30-year term home loan 7 years ago. So technically, if I keep going with my existing mortgage, I've got 23 years left to go. But I'm feeling the pinch, obviously, of the interest rate rises, so I go to refinance. Now, most financial institutions would refinance me and put me back on a 30-year term. So I don't have 23 years left to go until I'm mortgage-free. I have 30 years now to go on my mortgage-free. So that is the concern. You're delaying the final day where you pay off your home loan for good. And it adds obviously the cost of that, of your interest. If you look at your statements every month and you see that cost of interest, it's a lot of money.
I saw some banks recently that are offering not just kind of 30-year loans, but one maybe even offering 40 years.
That makes me feel sick.
Which is just, sure, the monthly repayments might be lower, but you will end up paying a lot more over time. But it's also a very, very long time to be shackled to a bank.
Exactly. And you've got to consider the fact as to where you are in your life cycle. So, for someone in their, say, mid-40s, taking out a 30-year loan, refinancing it now, is going to mean you make that final mortgage repayment at age 75. Are you still going to be earning an income working then? Don't you want to be debt-free, mortgage-free way sooner? So this is the thing, is it's a short-term fix, don't get me wrong. And I'm not saying don't go and refinance if you're in a tricky situation, but be aware of the consequences of doing this. And there are things you can do to help catch up and make up for lost time. Just like we talked about in our podcast, Is It Ever Too Late? You can apply similar principles to make sure that when things get easier, if you do have to refinance and you get back on your feet again, okay, well, don't forget, we refinance, we're back on that 30-year term. Let's look at making extra payments now that we've got our heads above water and got some security and stability back again. Let's try and get our loan term back down from 30 years to 27 years or 30 years to 25 years, or let's look at making some lump sum repayments if and when we can to help bring down that mortgage and get us back to where we were if we hadn't refinanced back then.
If you are going to refinance, what's the process? Is it a case of kind of meeting with the bank, or can you shop around and start actually wielding some of that power that comes with being a new customer and see what offers you can get?
You can contact the bank, you can shop around, but I would actually recommend delegating the research and the expertise to a mortgage broker, because they will have a great knowledge of what products are right for you. They'll have great connections for when things are a little bit borderline and they need to get something over the line. They will have a great understanding of, assuming you tell them what your financial goals are, paying off the home loan quickly, or maybe you have other intentions with your mortgage structures. So a good mortgage broker will really help you not just immediately save some money and stay on top of the mortgage repayments, but also will help you long-term, because when you find a good mortgage broker, they'll also let you know when there's a better deal going on, and they'll also call up the bank on your behalf and say, look, Mr. Smith has been with you guys now for 4 or 5 years. Can you give them a better rate on their interest rate? Otherwise, they're going to look at shopping around. So they'll often go in and do the heavy lifting for you.
And how does a mortgage broker get paid in that scenario?
They get paid commissions, which is normally an upfront amount, and then there's a small trail. I am not a mortgage broker. However, they must disclose that to you. It's all very, very transparent. And that is how they make a living and how they find you a great rate. And I've never, ever questioned my mortgage broker's fees. He has saved me hundreds of thousands of dollars in interest. He has worked with all of my clients, and when you get that phone call going, hey, Kenna, I spoke to the bank and I've managed to get you this discount on your existing loan, he's doing that for free. He's not getting paid for that. And quite often a mortgage broker sometimes will do all the heavy lifting and find out they'll get all the way to the end and the loan's not approved. And that's their loss of time. So it's how they work. I was
curious, because someone who's in mortgage stress probably wouldn't want to be looking for somewhere that they're going to have to pay an upfront fee, for instance, in order to be able to get that kind of assistance and support. A couple more questions on kind of refinancing. I want to get in a moment to some other options that we can look at if someone was, say, in mortgage stress. that might be an alternative to refinancing. But another downside, look, running that risk of making assumptions again, but is there another downside or potential risk with refinancing is that they will have to kind of assess you again, all over again for a home loan, and that if your circumstances have changed, you may not actually be eligible for a loan of the same level that you originally had. So if you've kind of lost your job, for instance, or you're not earning as much money as you were previously, or even just if the lending requirements on the banks have changed, that you may not even be able to refinance.
Absolutely. You are spot on. And there's also things like you've had another child. So you've got your cost of living in the bank's calculations is now different.
Yeah.
Or you might have your partner may now be working part-time instead of full-time previously.
Oh, yeah. Yep.
Or you are about to change jobs and you're going to be on probation for the first 3 months. That's a big consideration for the banks. Yeah. So it's not as easy as, okay, it's fine, we'll just go and refinance. You may not get the same loan amount approved, or you may not get it at all. And obviously you're going through a credit checking process as well. So there's lots of things to be considered, and that's where a mortgage broker can kind of filter all those risks out with you before you go down this path.
What about if the value of your property has actually dropped below what you paid for it? And we will have seen that happen probably in the last kind of 12 months or so, particularly with the boom in sales that we had kind of 2 years ago, and then the decline in values in the last 12 months, that there would be people who paid more than what their property is actually worth now.
Yeah, it is a real risk. And look, bank valuations in general, I think this is an assumption, they are pretty conservative because they do factor that in market movement. So, it boils down to a bank valuation, but that is most definitely a real risk. And it is something we will most likely see over the next 9 months or so as we see more and more rate rises.
Okay, so we've kind of covered refinancing to an extent in terms of we know how it works, we know why people do it, and we also know how it can go wrong. We'll come back in a moment and we'll look at some of the other options as well that people could pursue if they are in that position of suffering mortgage stress. Hannah, we've been talking about refinancing and refinancing traps. And when you're looking at your home loan and perhaps you are suffering mortgage stress in that kind of 30% of your pre-tax income or more is going to your mortgage repayment, and looking at the options available to you and potentially considering refinancing your loan, which means getting a whole new loan and potentially kind of restarting that whole process, the 25 years or the 30 years or more. If you don't want to do any of those, what else can you do?
Call your bank immediately and ask them if you can have a discount. Loyalty tax is expensive, but the banks are also very aware of the cost of finding a new customer. So if you say, look, Bank XYZ have a better deal going on at the moment, I'm thinking of refinancing, what can you do for me? Let them have a go at seeing if they can match it or even better, beat it. And that will mean that you're not, altering the time frame term of your loan. And hopefully they can quickly and easily get that discount approved and apply it to your loan straight away.
So you need to go into that, though, with some information. You need to be doing your research, seeing what is available elsewhere. And you also need a little bit of confidence as well. It's not the easiest thing to do. And I've done that call and it was successful as well. And afterwards you go, you know what, actually that wasn't so hard. I don't know why I put it off for so long, because you are right. There is a reluctance from the bank to lose you. They don't actually want to lose you. And if they
it's expensive to lose you.
Yeah. And how much information should you give them in that situation? Should you be telling them kind of, this is my financial situation at the moment. I am on limit.
I would recommend that you go in there telling them your goals rather than shooting yourself in the foot and say, I'm about to lose my job, I need a discount on my home loan. That wouldn't be very strategic.
Okay.
But say, I have a home loan. I'm really looking at our budget and I'm looking to shop around. I can see XYZ, I've got this rate going. I want to make sure I'm paying off my home loan as quickly as possible. So not only do I want to look at there's a better rate, I also want to look at what other structures or products may be more appropriate. A lot of people have these Rolls-Royce home loans with all the bells and whistles, the credit cards, the offsets, the redraws, the complimentary lounge passes, and you may not need all of that now. Those things often are hidden behind in expensive fees.
It
Annual
always
fees.
amazes me that there is an annual fee. I'm like, I pay the bank so much money in terms of interest, and yet there is then an annual fee on top of that for the right to pay you that money. I'm like,
Cheeky.
it does. It just feels a little bit rich.
You need to speak to my mortgage broker. But this is the thing is you go, actually, if my goal is very, very simple, which is to be mortgage free, which I will add is a fabulous goal to have and work on, maybe you just need a very basic no frills home loan. And quite often those basic no frills home loans are better value for money when it comes to looking at the interest rate. So really talk to them about what you need and what you want. What are your goals? What are you trying to achieve from a new loan structure, and let them give you some advice. And again, this is where a mortgage broker is going to be very, very valuable in your wealth creation journey.
And they can talk you through some of the other products that are available that may not necessarily be the same home loan that you've been on, but may potentially still involve refinancing, but also it's just worth kind of seeing what else is out there.
And look, the bank, if they're willing to work with you, they may say, look, we can switch you to this different product and we'll be able to keep the loan term the same and you'll still get the discount on the home loan. You don't know if you don't ask.
I'm going to ask you to do the impossible here and forecast what's going to happen. Should we talk to a mortgage broker about fixing rates in case there are more interest rate rises?
I would love to be able to answer this question with the most amazingly profound, high-value, accurate
Like, yes, there'll be 4 more
advice.
rate rises. Do it now. No, we can't do that, obviously.
No, I don't have a crystal ball, but it is very important to understand the limitations that come from fixed rates. And yes, I will admit, it will give you peace of mind that you're knowing what your mortgage repayment is going to be each fortnight or each month. But you need to consider the actual interest rate that you're going to be fixing at, because some of the fixed rates are higher than what the variable rates are. So it may actually end up costing you more money in the short term. But you also need to think about how long you want to fix the loan for, 2 years, 3 years, 5 years. And you also want to think about your own situation and what your goals are. You might intend to move. So if you're thinking of moving, can you move your fixed term with you? What happens if you want to sell? Now, this is where we ran into trouble because I thought I nailed it by fixing all these rates in at 2.2%. We would be laughing at the moment. Actually, no, we wouldn't be laughing because we'd be going to the revert risk. But I fixed a lot of our investment loans at 2.2%, but then we decided out of the blue I manifested this new house. We decided to sell and we had to refinance to a different bank. So we had to forego those fixed rates. Now, because the rates had started moving by then, we didn't have to pay any break fees. Mm-hmm. But if it doesn't, it can work the other way and you have to pay very expensive break fees to get out of your home loan. Actually, a friend of mine, it would have been about 10 years ago, had to pay $28,000 to get out of their fixed rate because they wanted to sell their apartment.
Oh, that is huge.
Huge.
That hurt.
Yeah. And they copped it because they wanted to go on to a new project in their life. Also, what happens if you want to refinance again in a couple of years' time? What happens if you want to make a lump sum repayment? You can't do that with a fixed loan beyond a certain point. And most banks will allow you to make between $10,000 and $15,000 per 12 months on a fixed rate, but you can't go more. And I've had situations where I've seen people fix their whole entire home loan and get a really big bonus, and they've had to put that bonus into savings. So it can't go into an offset account, can't go into a redraw facility. It had to sit in a savings account earning at the time
next
not
to nothing.
Much,
yep.
While they had quite an expensive fixed rate.
Oh.
So that is why it is advisable to get advice, but it's also advisable to maybe consider fixing half or a third or a quarter or something like that to give yourself some breathing space. But you've really got to look at your situation and what your intentions are and your goals before you go and jump in the deep end and fix everything, and know the fees. And those fees do obviously get smaller and smaller as you go through the fixed term period. So it might be $28,000 for my friends, but if they waited 6 months, it may have dropped down to $20,000. You can get a guide from the bank as to what those break fees may be. But you need to know what you are doing before you make informed, educated decisions is what the technical term is.
Makes sense. We're running out of time. We started talking about refinancing, so we'll finish talking about refinancing. If we do decide to refinance, How do you make it work for you?
All right. So if you are stuck and you must refinance is the only solution, make sure that any savings you get from a cheaper, more cost-effective interest rate are going towards the mortgage. So say, for example, my mortgage repayment is $3,000 per month. I refinance, now comes down to $2,700 per month.
Yep.
Don't go and spend that $300. Try and maintain what you were previously paying, which is the $3,000, and put that $300 extra to helping the mortgage reduce.
If you can, though, because chances are if you're in mortgage stress and needing to refinance in the first place, you might need that $300 for food.
Exactly. And know that it isn't forever, these tough times. It will get easier, it will get better. And look for solutions. Really look at what you can do to earn extra money, as a side hustle, extra work to try and help you build some emergency savings. Use your offset account, use your redraw facility to save interest in the meantime, and to try and make those extra payments so you can get back on top and keep your chin up.
Okay. Look, I found this really interesting because refinancing is a term that you hear a lot, but there is a lot more to it, and it could be a quick fix, but it's a quick fix that might come with a few downfalls.
It's a bit of smoke and mirrors.
Yeah, well, I like that one. So really, we've talked about kind of mortgage stress and that being that point at which, say, 30% or more of your pre-tax income is going to your mortgage repayment. So people are kind of thinking about refinancing, thinking about options, particularly those who are perhaps rolling off the fixed rate loans onto a higher variable rate and suddenly going, I might be paying an extra $1,000 a month in interest. So if you are one of those people that is considering refinancing, do your research and speak to somebody who's able to help you, potentially a mortgage broker who is able to actually give you some advice on kind of whether it's going to be the right decision to you. Obviously, speak to your financial advisor if you're able to do that, and be wary of some of those downsides to refinancing. The fact that it is not just getting a new lower rate, it is getting a new loan, and that will kind of restart the clock for another kind of 25 or 30 or 35 years potentially, and it is a very long time to be kind of stuck with a mortgage. Be aware that it will involve kind of reassessing your income, and your circumstances might have changed. The value of your property might have dropped below what you paid for it. Look at what you can do with your existing bank. Make a call to your bank and see if you can just ask for a lower rate on your existing home loan, and talk to them about what your goals are and how you might be able to achieve them. Talk to a mortgage broker as well about the potential for fixing rates, and make a decision based on whether it is right for you. If you do refinance, just try and keep paying that mortgage off as quickly as you can. And if you're able to, put that extra money that you're saving towards paying off that loan so that you don't end up with that bank for another 30 or 35 years, that you are able to hopefully reach that point where you are potentially, hopefully, one day mortgage free. Because I think that sounds pretty good to me.
I think if I continued, this podcast would turn into a 45-minute podcast because I'd be talking about all the amazing things you can do when you're mortgage free. So I won't.
Well, you know what? That's actually something that we could talk about next time. Not necessarily things that you would do when you're mortgage free, but just amazing things that you can do in general, even when you're on a bit of a budget, because we might actually talk about that, entertaining on a budget, in our next episode. In the meantime, though, Canna, how can people find you?
The fastest way to connect with me directly is probably through Instagram at SugarMamaTV or Canna Campbell Official. And then, of course, I have my Monday morning podcast on Sugar Mama's Fireplay, where we talk about all these things in more detail, including lots of manifesting magic.
You make it sound so serious. You can hear me every day with Sean Aylmer on Fear and Greed, which is Australia's most popular business news podcast. You can even find my novel if you want to, How to Be Remembered, wherever you buy books. Thank you very much for listening to How Do They Afford That? Remember to hit follow on the podcast so that you get the next episode directly in your playlist. You can leave us a review as well if you like. We love those. Next week, we are talking, as I mentioned, about entertaining on a budget. It is probably what we need right about now. Don't miss it.